Friday, February 12th. You need to be old to have seen what the world is going through right now. I mean, not that old, but 1997 and 1998, we went through a period called the Asian contagion, in which, at the heart of it, currency issues, debt issues, caused a chain reaction event through Asia, then into Europe, and culminating with Russia defaulting on its bonds, in which the outside world looked as though it was going to crash into the ground altogether. And authorities here were worried. Time magazine's cover, if you're really old, had Alan Greenspan and Larry Summers and Robert Rubin, and called them the Committee to Save the World. And they were so worried that the contagion would come on shore here in the United States that the Fed actually began to ease policy. And the reality turned out to be that all the trouble overseas poured money into the United States, pushed down our interest rates, pushed up our stocks, and actually made things better. And meanwhile, the Fed eased, which added gas to a stock market bubble. This time around, the world is in somewhat more serious trouble. The central banks, which are the fire brigade for each nation, are in many cases more tapped out now than they were then, 20 years ago. But for the time being, all of the trouble is overseas. There is not the slightest sign in good U.S. forecasting models data that the U.S. economy is doing anything except muddling along the way that it has been. Yet, mortgage rates, as of yesterday, got within 0.25% of the all-time low, which was in 2012. We're under 3 3/4, approaching 3.5. The 10-year Treasury note was likewise within 0.25% of its all-time low. Our stock market has had a hard time for reasons unique to stock markets. The U.S. stock market, the Standard & Poor's 500, earnings, about 60% of those earnings have been overseas for a long time, back 15, almost 20 years. And they've been rising, earnings have been rising because of global trade, the emergence of China, but really just global trade. And global trade is slowing down, and the China engine is slowing down. The emerging nations that used to sell things to China are not selling things to China. And so as those earnings go down, and also as they lose value in dollar terms, as the dollar rises and other currencies go down, earnings look lousy. And so the stock market falls out of bed. But our stock market hasn't remotely had the trouble in, say, Japan, or the world as a whole. And some of those stats and charts are in the copy nearby. I wouldn't fool with bottom fishing on interest rates. If you have a refinance to do or a house to do, do it. It is possible that we will go lower. There's even some likelihood that we'll go lower. But all we need is an agreement in OPEC to trim oil production and have oil prices go up a little bit, and rates will go up a little bit. All we need is the sense of stabilization in external economies, and up will go again. But it's a strange patch to go through, but hang on to the seat of your pants. The data says the U.S. is fine, and this trouble's overseas. So have a good weekend.